Greetings. This video is going to be a remake of one of the early videos on this channel, and that was made early in the life of this channel, and so the production quality was not very good. So I'm remaking it, but with some new points and tighter production as well as some updated data. So it's not merely a repeat, it is an augmentation, a new and improved version, if you will. So Peter Schiff is someone who has been right about certain things in the past, such as calling the housing crisis before 2008, as well as calling the higher education bubble. And while that hasn't popped yet, Peter Schiff has done some extremely valuable work in terms of making people aware of the higher education bubble and exposing the poor cost-benefit analysis of most college degrees in the modern era as opposed to 30 or 40 years ago. So he has been right about those things, and I've been a fan of his for some time on those particular subjects. But these days, however, his latest narrative is that hyperinflation is imminent, and the way to hedge hyperinflation is to buy gold. Now, if you're a regular viewer of this channel, you know that both of those two narratives are wrong. Federal Reserve money printing does not cause high inflation up to a pretty high ceiling of printing, which we have not breached even with the huge amount of world monetary creation that has been done. And even if there were to be hyperinflation, gold is not a very good hedge for hyperinflation. So I'm going to debunk Peter Schiff's narrative point by point, and we're going to start with his recent appearance on the Kitco news channel, where he is explaining why he thinks there's going to be inflation based on Federal Reserve quantitative easing that has been going on for 11 years already, and why gold is going to shoot up in price because of that any day now. So we begin with this clip from Kitco News.
Now, during my Bloomberg days, Peter, you were one of the very few that called it correctly ahead of the 2008 financial crisis. You cautioned against subprime mortgages and how the housing market was going to collapse, wreaking havoc across the financial system. And look, you were ridiculed by some at the time, but we all know how that turned out. And as bad as that was, you are now forecasting far, far worse. Now, and when do you think we will see that inflation surge?
And I think the low inflation that we've enjoyed over the last 20, 25 years, I think a lot of that is through sleight of hand. I think that the CPI has actually gone, has not really reflected the extent to which prices have gone up. So I think we're understating the increase in consumer prices. Plus, a lot of the liquidity, the inflation that the Fed was creating, it went into the stock market. It went into the real estate market, into the cryptocurrency market. Into the bond market. So I think a lot of these bubbles, as they deflate, the money is ultimately going to go into consumer prices, commodities, and things like that. And so we're about to see a tsunami of inflation. And whether the Fed is oblivious to it or just lying about it, there's no way to know.
Well, speaking of CPI, again, harking back to my past, I recall one of your very colorful analogies that stuck with me. And you said that having the government control the CPI data is like having the mob give a report on crime. So very effective messaging that certainly gets the point across. So given we can't really trust the government with regards to the accuracy of where inflation is and where consumer prices are really headed, what did you use to make your assessment to figure out what the real rate of inflation is? And you say we're headed for a tsunami of inflation. When? I mean, that is the big question, Peter. When?
Yeah, well, in my mind, I think it's already started. And again, I don't think we're transitioning, or it's transitory, unless you're saying we're transitioning from low inflation to high inflation, which is really what's happening. But what you want to look at to understand inflation is you look at the money supply. Because it's the money supply that was being inflated. I mean, literally, that's where the word comes from. So this is massive inflation. And so to expect that prices are not going to respond by rising is ridiculous. But then you also have to look at the supply side of the equation, because as the Federal Reserve is dumping all this newly printed money onto the economy, there's actually less stuff for people to buy. Because more and more people who used to be engaged in productive activities, whether they were producing goods or providing services, a lot of these people are now sitting at home collecting these government checks. So we're creating more money to buy goods, but we're producing fewer goods to buy. And so how can prices not go way up? I mean, anybody who doesn't think the price are going to go up. I mean, just not only don't they understand basic economics, they just don't even have any common sense.
Yeah, but then how do you account for the fact that we have gold sort of hovering at the 1730 levels, has dropped below 1800 as we're getting yet another round of stimulus, more and more reasons to back up your argument, but we're not seeing that movement in gold? Is that because, to your point, people still just have all this faith in the Fed?
Absolutely. I mean, that's the point, is that people are looking at all this monetary policy, all this inflation of the money supply. They're seeing all these cost increases. They can say it's because of supply bottlenecks or shortages, but that's always the case. You know, if you print too much money, there's a shortage of everything, because you just, printing money doesn't create products. Creating products is what enables consumption. Printing money doesn't enable anything. It just lets you bid up prices. So you can always blame it on a shortage of goods, but it's a surplus of money that is the problem. But yes, during COVID, there was a reduction too. So we compounded the problem. But the reason that you're not seeing a lot more money going into gold, especially the bigger institutional money, is yes, they do not yet perceive the threat. They think everything is fine. They believe Powell when he says inflation is transitory. So they're not as concerned. They just like they believe Powell or the other Fed chairs, Bernanke or Yellen, when they said, QE is only temporary. We're going to shrink our balance sheet back down to pre-crisis levels. We're going to normalize interest rates. These were all lies that the Fed told, yet the markets believe the Fed, and now they're telling more lies, but the markets continue to believe every lie the Fed tells, and they don't look back at their track record and say, hey, these guys haven't really been honest in the past. Now, again, maybe it's not honest. Maybe they're just wrong. Maybe the Fed is just wrong in everything it says. If it's just wrong all the time, well, then why believe them now? If their track record is they've always gotten it wrong, why would they believe that now they're suddenly going to get it right? But I do think that at some point, and I don't know when that point is going to come, but I don't think we're that far off, more and more people are going to start to doubt the Fed. The Fed is going to start losing a lot of its credibility, especially as inflation continues to pick up and the Fed continues to dismiss, any concerns by holding steadfast to this idea that there's nothing to worry about, that it's transitory. So at some point, people are going to call the Fed's bluff, like, okay, you can't do anything about all this inflation, and then gold's going to take off, right? So the opportunity now is that while most people don't perceive the threat and are just acting as if everything is fine and investing as if inflation isn't a concern, that's why gold is a bargain, and silver too, for that matter, for all the people that do understand where this is headed and can think ahead of the curve, right? So people who are watching Kitco, right, we can all load up on gold and silver and these type of stocks.
Okay, we can stop right there. Now, let us examine his points and go through the details about why he is wrong, because his entire premise is that the Federal Reserve is printing money and somehow that is going to cause very high inflation and gold prices will go up. Now, he is wrong for three very, very clear and important reasons. So let's look at the reasons why Peter Schiff is wrong. Reason number one, monetary creation, also known as printing, although that's not technically correct, it's not really printing, in reality offsets technological deflation, which is exponentially rising, explaining the absence of inflation. Let me go to a report that has some charts that shows you the truth about this type of monetary creation. Over here we have a central bank monthly balance sheet report from Yardeni Research, and the URL for this will be in the description box below. And we scroll down. First of all, we see the four major central banks of the world and how much money they have printed. This is not the entirety of world money printing, but it's about 85 to 90% of world money printing. The red line is the United States, the US Federal Reserve. It's not even the biggest contributor to printing. The blue line, the European Central Bank, is the biggest contributor to money printing. So the US Federal Reserve is responsible for only 25% of the entire world's monetary creation. But we'll come to that point secondly. More importantly, this has been going on for at least 11 years. Monetary creation in response to the housing bust crisis of 2008-2009 began in earnest. And since that time, these four central banks combined have done $30 trillion of monetary printing. And it's just been rising exponentially. And that number matches up with exactly the proportion of the economy that is considered high-tech, and the calculations of how much technological deflation is yielded in the economy from that exponential technological progress. And most importantly of all, we go to this chart below, which is the same chart as we just saw, but the percentage year-over-year gain. So when we see above that this is rising exponentially, what is the percentage rate of increase of world monetary creation? It's been ebbing and flowing, crisscrossing 10% a year, and it was actually going down in 2018, 2019 because the central banks of the world still misguidedly think they can undo all their money printing because they don't understand why money printing is not causing inflation. And that way, they're just as bad as Peter Schiff. And in response to COVID, there was a huge amount of money printing that created a 46% year-over-year gain in money printing. Now, according to my atom thesis, the ideal band is a 16 to 24% year-over-year growth rate. This was in excess of that, and so even I thought this might cause very temporary inflation for the duration of time that it's above 24%, but guess what? Even that was muted to nothing. It was still at the noise level because now, because the rate of increase is no longer increasing, the second derivative, by June, which is the most recent month of data, June 2021, the year-over-year growth rate is now only 19.3%. That is well within my band of 16 to 24%. If there's a lag effect of past printing that may cause a brief flurry of inflation, well, the time is running out for that to even occur because that peak was in February. Now we're already in late July at the time of the creation of this video. So the lag effect of this money not having circulated yet has to happen soon. Otherwise, it's not going to happen at all. So that is one of the reasons Peter Schiff is wrong. So we go back to our PowerPoint. Point number 2, we also talked about monetary creation is borderless. The Federal Reserve is only 1/4 of all world money printing. As we saw, the European, Japanese, and Chinese central banks are the other big central banks that are printing money, as are a number of smaller central banks across the world, such as the Bank of England and others. So his whole thing about the Federal Reserve has created so much money that it has to cause inflation. Well, the United States is not the only country in the world. All this money printing is borderless, and we are in a software-based economy to a greater and greater extent these days. When a software product is produced in one country and bought by a customer in the other country, there's no material consumption in that transaction. So money printing is borderless, and a lot of software makes certain other economic activity borderless. Not all activity in the world, of course, but an increasing percentage of activity. And therefore, his fixation with the U.S. Federal Reserve and complete omission of all the other central banks in the world from his entire discussion on the Kitco channel kind of makes me suspect that he still is in a 1970s, 80s mindset where by default one acts as though the U.S. is the only country in the world. And what's odd is that his firm is called Euro-Pacific. Euro-Pacific. That implies someone that has a global outlook. But apparently from what he's saying, he's only fixated on the U.S. Federal Reserve as if it's the only country in the world that's printing money, and nothing could be further from the truth. So point number 2, why Peter Schiff is wrong. And then we go to the final point, point number 3. Even if inflation were to happen, gold and silver are not the hedges of inflation. The hedge of inflation is real estate that is leveraged with a mortgage, or the stock market, the S&P 500. Gold and silver are inert commodities and are not hedges for inflation. Technology always increases the supply of any such commodity, and more so now than before because the technonomic medium of the world has become more and more advanced, as you can learn about if you read my Atom publication. As the price of gold rises, there's more incentive to increase supply because people who are in the business of finding new supply have a greater profit margin, and more technology and more capital gets deployed for that. We saw the same thing with oil prices. Do you remember when everyone was screaming about peak oil from 2007 to 2014? Well, I made a very famous prediction in 2011, and I have a video about that in this card up here that you can watch. How I predicted oil prices would go below $70 and $70 would be the pivot point because technology is now advanced enough that it can very rapidly increase the supply of any such commodity such as oil or gold, or otherwise create alternatives to that commodity, such as electric cars that don't consume oil. And both of those technologies work in combination as well. So with gold, if the price gets too high, technology will increase supply. There are many, many technologies that can increase the supply of a precious metal. Everything from drones that increase the efficiency of prospecting by a factor of 100 because the drone flies around and shoots electrical pulses in the ground and tells people exactly where the gold ore is, to asteroid mining, which might be 15 to 20 years away, but we've already identified asteroids that have tons and tons and tons of gold and platinum and other such precious metals. In terms of today's prices, we've already identified asteroids that have $20 trillion of gold and platinum. Of course, once we begin to access those asteroids, the price will plunge, and that much gold and platinum will not be worth anything close to that amount, of course. But that is how technology always finds a way to increase the supply of any commodity, especially now when the technonomic medium of the world really is that advanced. A spike upwards in oil prices did not create a rapid increase in supply in 1974 and 1982, the two times where we had an oil shock, because the technonomic medium of the world was not as advanced at that time. But by 2014, it became super advanced, and we got a supply increase through hydraulic fracturing. And now we have electrical vehicles that are further reducing demand for petroleum-based products. So oil prices have a tremendous amount of downward pressure on them, and gold and silver are the same. And to just illustrate how there really is not inflation, especially as measured by commodity prices, we go to an indisputable international index, the Goldman Sachs Commodity Index. See, someone like Peter Schiff, as well as all other inflation mongers, they like to say that the US CPI is rigged and not reflecting the true amount of inflation. Well, the Goldman Sachs Commodity Index is not rigged because it tracks actual commodity prices, and it's a worldwide index. All these things like gold and silver and oil are in worldwide unified prices, so it cannot be rigged by the government of any one country. And this is the 10-year tracking of the Goldman Sachs Commodity Index, as you can see here, 10 years. And the average annual rate of increase in the Goldman Sachs Commodity Index is minus 2.72%. So over the 10 years that the world has been printing a lot of money that we saw earlier, $30 trillion printed in the last 11 years or so, most of that in the last 10 years, obviously, has nonetheless caused commodity prices to go down in price, minus 2.72% a year. That is deflation, because technology continually increases the supply of these commodities, and no matter how much money is printed, it is unable to push these commodity prices higher. Now, commodities are not the entirety of what a person consumes, of course. Services, which are provided by other humans, are included in that. But commodities are the purest measure of inflation because they are inert objects. A service is more complicated because it's the person's salary. The people who whine about service prices rising too much are the same people who will say that people's wages are not rising fast enough. An increase in service prices is an increase in wages, and both sides get more prosperous only through productivity gains in the service provisioning. And that's a topic for a different video. But over here, you can see that the actual commodity rate of inflation is in fact negative, meaning we are in deflation and have been for 10 years. This is not some selectively cherry-picked window. This is a 10-year chart of commodity prices. Oil, gold, silver, etc. are all included in this index. So Peter Schiff is wrong, wrong, and wrong. And furthermore, people who are bullish on gold never discuss the poor returns of gold. And I have a video about that, as you'll see in this card I have up here. All these gold bug type people never actually discuss the returns of gold, because the returns of gold are terrible. And anyone who believes that these metals are a hedge against inflation, even if there were to be inflation, are effectively making a bet against all technological progress. And I can think of nothing more foolhardy to do than that. Now, Peter Schiff has been right about some other things that I described at the beginning of this video, and I'm not trying to bash him. He is a knowledgeable finance person who simply doesn't know anything about technology, and that's why his old models, which were appropriate in the 1970s and 80s, no longer fit the high-tech economy of today, and that's why he is confused and befuddled and running out of excuses for why what he expects to happen is not happening. Now, I hope he sees this video, or that some of you watching this can send this to him, and I'd like to reach out to him in friendship because, again, I do agree with him on certain other things, and we can have a lively gentleman's debate about the topic of inflation and even discuss the things we agree upon, and that would be some very entertaining content for YouTube as well. So I would like to reach out to him amicably to discuss this to the extent that we could, because I believe I can even save his entire investment thesis by simply explaining to him the new economics of technology and why I have a track record of all these predictions being very correct, especially regarding inflation and commodity prices and equity prices. And given how poorly his own investment thesis has been doing in recent years, I would be more than happy to help him out on that front. So I hope you found this video interesting, whether you agree with Peter Schiff or not. And if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.